Hello, everyone. Mark Rusin here, and we are live for another edition of the Dividend Power Hour. Let me know where you guys are tuning in from. I already see some comments in there. Let's see. We got Paul is roasting in Corona. Paul's not too far down the street. It's pretty hot here too, as well, Paul. I'm in Orange County area, and it is close to 90 degrees, so it is pretty warm. It has been pretty warm, but all of a sudden, there's apparently a hurricane that's headed towards California, so we might get some rain here in the next few days. I think Saturday, Sunday is when it's supposed to hit. But let me know where you guys are tuning in from, and let me know what did you buy this week. Since we last spoke last week, let me know, have you bought any stocks, whether it's dividend or growth stocks? Let's hear what you have going. And again, we put this together, this Dividend Power Hour. It's an opportunity for you to ask questions and me to go through those live, the ones that I do know. It's my opportunity just to discuss what's going on with the economy with you guys. You know, I'm always in the markets each and every day, but I like to hear other perspectives as well. So it's always great to tune in with you guys. I love doing these Dividend Power Hours. So make sure we keep tuning in, hit that like button. And I know you guys really appreciate it. And I love interacting with you guys. So, okay. Andre is here from Sydney, Australia. Andre, great to have you. I actually just wrapped up one of my 6-week investing accelerator course with a gentleman that was in Australia. That was quite the difference in time zones, but we made it work and got through all 6 weeks. So that was definitely fun. Thanks for tuning in. We got Paul over in Corona. What else you guys got, and what are you guys buying? Let me know. I see Jim is in there. Angel from California, he bought some SCHD. But what's happening with WPC? So WP carry, and it's really just the REIT sector. I mean, you can look at Realty Income. Last I checked, they had a dividend yield around 5.4%, which is just insane. Anytime it's over 5%, I always like to say it's a solid valuation. We've just been dealing with these higher interest rates. It looks like they're going to continue. We're going to get into that with the Dividend Power Hour here when we put up the slides. But we thought we were near the end of this rate hike cycle, but we're continuing to see that a lot of the Fed officials say we may not be done yet. Inflation is still pretty sticky. We may need a few more, and that's going to continue to put pressure on REITs, even the highest quality REITs, WPC, and the likes of Realty Income. So let's jump in. You guys keep smashing the, let me know what you're buying so I can see that, but I'm going to throw up our slide deck here. So let's take a look at what is happening in the markets this week. We have our normal slide that we always got going here, our economic outlook. So let's just take a look at where the markets are. So just a quick update on the markets. The Dow Jones Industrial year to date is up 4%. But we see here the last 5 days, the last 5 trading days, it is down about 2.2%. Turning our attention over to the S&P 500 year to date, it is up 14.3%. Which is a solid year right there. If that was a full year, full 12 months right there, we'd probably be pretty happy, 14.3%. But over the past 5 days, we see that we are down 2% in the S&P 500, and then the NASDAQ is up a staggering 28%. Now, that is down from the highs that we had seen earlier in the year, and over the past 5 days, it is down 2.2%. So all 3 major indexes down over 2% just in the past 5 days. Are things starting to crack? Or are we just taking a bit of a breather before we start moving higher? So I did finally start seeing some estimates. We are estimating EPS of $2.19 now per share. That's on the S&P 500. If you recall, in the last weeks that we've done this, it's been around $230. So those are starting to come down. So we have estimates coming down. We have the S&P 500 stock price coming down, and that actually brings our PE ratio up. So we're at 19.9 times, even though the index fell last week, it was at 19.4. So as we know, the 10-year average is 17.4 times. Still a pretty sizable gap there, something to keep an eye on. So it's good to see those estimates starting to fall down. And I can kind of show you guys what we're looking at in terms of the estimates here. So this is from Yardini Research here. They show you their estimates based on years. So if we go down here to 2023, you can see they have estimates of 225. Those are their own estimates, but the consensus right now is at 219.43, and then they kind of break it down by quarter there. Q2, as we've talked about a bunch on this channel, is by far the worst, coming in around -6, maybe -7% once all the dust settles, we should say. But we're going to start turning the corner here. Q3, we should see flat year-over-year growth. And then Q4 is supposed to be massive. And you could see the growth, though, in 2024 I should say, which is that's really what a lot of folks are betting on, because when you're investing in the stock market, it is forward looking. You're not investing with what's going on today. The stock market doesn't work that way. They are looking 6 months or so or more in advance. So don't look at how the economy is doing right now. Try and when you're investing, how are things going to be? And that's that long-term approach that I talk about a lot. We have some great valuations in many dividend stocks right now, or even some growth stocks, but the tech sector is starting to take a bit of a breather, and we're going to look at some of that today. But like I talked about at the top of the show, Realty Income is one of those that is looking quite intriguing there. So let's see what else. Head over here to the comments. We see Chris in from Long Island. What else we got? We have Kenny bought some Visa today. Visa, I do like that one a lot. His first share of Visa. And let's see. Roland's in the house. Hi, Mark. Big fan. Thoughts on AMT's future, considering tech advancements such as Starlink? So, Roland, yeah, I just recently did a video on American Tower. It's actually my latest video, and I did 2 REITs that are insanely cheap and 1 REIT to avoid. American Tower, definitely check that video out. But American Tower was one of those REITs that I was talking about. And the reason being is, yes, Starlink and these satellite type technology advancements are definitely, but they're still such a small piece of the overall pie. They're still advanced. I mean, American Tower is still dealing with things of 3G and 4G. We're already at 5G and talking about what's next, the 6G or whatever. So there's still a lot of headroom. So if you're looking for like a growth opportunity, then maybe something like a Starlink, someone that offers those satellite type things, could be a potential growth. There's going to be a ton of volatility though in it. American Tower though, they're going to be around for a long time. They're dealing with some issues, some headwinds. All the telecom providers are dealing with headwinds right now. So American Tower is definitely one that is insanely cheap in my point of view, and one I want to look at even at these low points here. But I hear your argument. I hear that one a lot. Definitely something to keep in mind though. Hello, Mark. Love your content. Buying SCHD. Love SCHD. Chris bought some Home Depot, SBGI, and some Realty Income. Awesome. Roland also bought some PLD, which is a favorite REIT of mine. Which is, my opinion, the best. Yeah, absolutely agree. Well, it's one of the best, I should say. I'm not going to name out one single REIT that I like the best, but PLD is definitely up there. They are their premier warehouse industrial REIT. They have customers with the likes of Amazon. It's just a play on e-commerce. As e-commerce continues to penetrate more into retail sales, you're going to have somewhere to put all of this inventory. You know, there's not going to be folks that are running these stores out of their garages. You need to go rent some space, have some inventory. Amazon's going to continue to grow as well. So PLD is definitely going to benefit from that. We bought some Tesla here. We got a sell here from Tim. I sold off ORC, which was paying decently. Sacramento, it's 107. Holy smokes, that is insane. Hola, is it time to buy in this market now? We're going to talk more about that, so make sure you stay tuned here. Where are we looking to buy Tesla at in the long term? Tesla's been, let me see if I have that chart up. I'll go back here, add that to the stream there. Let's take a look at Tesla. Go to our trading view. We don't look at Tesla on this show. I mean, I trade options with it a lot, but you can see that next really support level we're looking at is really around 209. And if they break that, we're talking about dipping below 200. So I'm probably going to wait and see. It's just on that downward spiral right now. RSI is looking pretty solid though, very low. So I could see selling. I don't own Tesla. I sell options around it all the time. So if I do own it, it would because maybe I sold a cash secured put. Those got called away. I had to buy the shares. So, but I just turn around, do the wheel strategy, and sell some covered calls on top of that. But right now, I do not own any Tesla. So I'm looking right around that 209, and under that, if it breaks that 209 level, I think we're going to fall below 200 there for Tesla. So don't want to spend too much time on Tesla, so we don't talk about Tesla all that much. But what other questions do we have? Chris shorted SMCI. Awesome. SCHD, some DGRO, TFC. Awesome. So some of you folks were busy this week. So that is awesome. So let's continue on here with the slide deck. So we looked at valuation, we looked at the markets, and now let's look at interest rates. If you notice today and the past few days, we've seen a boom in interest rates. The 10-year went up to 4.29% as of putting the slide deck together. The 2-year was at 4.94. But as we were looking at it, and it was pretty much midday, I started to see this move last night in the overnight, the 10-year reached 4.33%, and the 2-year touched 5%. So that was definitely something to kind of look at. It's really this battle that investors are going through, talking about this soft landing. We talked about this a few weeks back, talking about what a soft landing is and how the Fed is trying to put together this where they're able to keep employment together and bring down inflation at the same time while keeping interest rates higher. They're hoping to just not really, let's call it, not disrupt the stock market, not disrupt the jobs market. They really care less about the stock market as much as they do the job market. That's a different story. But and that's really starting to be priced in. For a while, it was no, they can't do this soft landing. There's no way. It's really rarely ever been done, and that's still the case. But now investors are starting to get a little bit more comfortable. Okay, the stock market continues to increase. Sure, we saw Q2 was a rough time for a lot of these companies reporting earnings, especially the big tech companies as well. But they're holding up, as a phrase that I hate the most, better than expected. Well, sure, if you bring estimates way down, things can look better. You can make anything look better than expected. But sure enough, Q2 was a rough year in terms of earnings growth, but we see that estimates are showing that things are supposed to move drastically. Q3 we're supposed to get right around flat, and we saw Q4 is when we'll get double-digit earnings EPS growth again. So that's something interesting to kind of look at. But the thing is, and the scary part is the hard landing is no longer kind of priced in. Everyone's expecting the soft landing. So let's say things go haywire, inflation creeps back up, we start seeing unemployment go from 3% up to 4.5%, then I think things can really hit the fan and we could see a hard sell-off if that happens. I'm just saying if those particular things happen, that's where it's kind of, I'm trying to be mindful of that and kind of be conservative from an investor standpoint when putting fresh money to work. So right now, if you are a subscriber to the our Dividend Investors Edge newsletter, the premium one, you could see my dividend portfolio and I show my cash balance there. You can see where does my cash balance rank up. And right now it's about a top 10 position, maybe even a top 5 position last time I looked, just due to the fact that I'm waiting for some bigger opportunities to happen, especially in big tech as well. So something to definitely keep an eye on there. So let's move our attention now over to employment, where this past week we saw jobless claims decrease by 11,000 to a total of 239,000. So that was definitely a positive, just showing the strength in the job market. But the 4-week moving average was 234,250, which was an increase of 2,750. So that's one I like to kind of focus on more, is the moving average rather than the week to week. There can be a lot of volatility, especially if there's holidays, like we had a month ago or so. We had 4th of July, and that kind of just swung things. So focusing more on the 4-week is what I like to do. Continuing jobless claims. These are folks that continue to be unemployed, not able to find jobs quickly. We're at 1.72 million. The street was looking for 1.7. So we came in a little bit higher there in the most recent employment report. So something to kind of, it's an area that I continue to keep an eye on closely, because if we start to see unemployment start to creep up, that's when the markets could start to falter a little bit more. So housing right now, average 30-year mortgage is at about 7.1%, the interest rate there. That is the highest level in over 20 years. A $350,000 house, if you had put down 20%, so put down $70,000, and you took out that loan, we were talking about, from now looking back, or say just 3 or so years ago, that would equate to $720 more per month for the same exact loan. That is just staggering to see how the 30-year has moved. But I mean, it makes sense because we're looking at a 10-year of 4.3 right now, and usually the mortgage rates kind of watch closely that 10-year bond interest rate there. So another thing that we saw recently was retail sales this week. I think it was on Tuesday. We saw that retail sales uptick by almost 1%, 0.7% on a month-over-month basis. And then on a year-over-year basis, retail sales came in higher by 3.2%. So we got some more information on the consumer, and we got it not only from that report, but we also got it from retailers who reported earnings this week. So let me head over to the comments here and make sure I'm not missing any questions that you guys have for me. Chris liked the video on ARE and AMT. I'm going to buy them. Awesome. Thanks for that. Mr. Snazzy's in the house. He bought some Moderna this week. Under 100 is a bargain. TT bought some TFC, SCHD, and DGRO. I think we saw that one. Paul bought some AMT, VG, DG. What is your view on DG? So Dollar General's kind of been struggling. Let me pull up the share here, and we'll pull up the chart here on Dollar General. Oh, I already got it up because I saw your question ahead of time. So you can see Dollar General's down 37% over the past year. If we look out 6 months, they're down. A lot of that's come right now. We're almost down 30% in the past 6 months there. And they've kind of stuck right around even over the past month. So Dollar General, that one's kind of interesting in the fact that we've kind of seen from this retail information, we've seen a lot of consumers that are looking to buy down. So we're going from higher end luxury type products. Even if you're going to shopping, now you might be going to more of the store-bought, the Kroger brands. We're starting to see that a lot more. Even the Walmarts and the Targets made mention of that. Their own products are starting to see more of an increase, an uptick, which they like. But it also kind of proves the point that the consumers are starting to feel a little more, feeling this inflation, feeling the higher prices, and it's starting to show through that data. So Dollar General, though, should fit in that bill. It should fit in the same bill that, with Walmart, Target folks. But the same thing that we're seeing with TJ Maxx. They had a blowout quarter we're going to look at in one of the slides here coming up. So Dollar General is definitely one that, when I looked, I pulled it up and I looked at them like down 38%. I would have thought they would have start to turn the corner a little bit, but they're sitting there at a 52-week high. Definitely one that I'm going to add to my list, and I'm going to do a little bit more research on for you there. So I'll get back to you on that one, Paul. And maybe we can get into it on a video that I'll do right after this, the conclusion of this. So anyone that subscribes to my YouTube channel, if you are a premium subscriber to the YouTube channel, I do dividend portfolio updates. So we just started doing this. So we do mid-month portfolio updates. The only ways that you can see my dividend portfolio is being a subscriber to the YouTube channel or being a premium subscriber to the Investor's Edge, my Dividend Investor's Edge, which you get stock deep dives in addition to the dividend portfolio updates and our valuation dashboard as well. So definitely stay tuned for that, and I'll try and get you an answer for that one following this one, Paul. What other questions? Matthew's in the house. Good day. Canada has a worker shortage for 2 years running now. Mr. Snazzy, if you had 50 plus more years ahead to invest, let's see. Wow. I hope I still have 50 years still on Earth here. Does it really matter that much at what prices you buy right now? Yes and no. I understand the long-term point of view. I'm a long-term investor. I talk about it on my videos all the time, but I don't blindly invest in companies. If you're looking at a house and there's two houses right there. You have one that sold for $300,000, we'll say 2 months ago, and the one right next to it's the same exact house, but now it's selling for double. Sure, long-term, I'm going to say, well, the prices are, if I'm here for 50 years, it's likely going to be higher, but it's not a good valuation. That's where valuation comes in. And that's where I want to try and find long-term great entry points. It may not be a great entry point right now. In terms of valuation, it'll be a great entry point, but there can be disconnects from what the market's doing right now. So if I get into a stock that tends to trade at a price to earnings of 15, it's trading at 8 right now. We're seeing continued free cash flow growth. We're seeing EBITDA continue to rise. They have some new, maybe it's a pharmaceutical company. They have some new strong pipeline drugs that are still coming online. All of this stuff is just lining up. Then that's a good valuation, regardless of where, I can foresee where something is going. Whereas I don't want to just jump into it just because I have 50 plus years. So valuation does come into it for me. I'm someone that's in the market, but if you're just dollar cost averaging, want to be a hands-off investor, then sure, especially if it's ETFs. I don't mind just going in and setting up a, $100 a week, $200 a week, whatever it may be in an S&P 500 index fund or ETF. So definitely get the question there. It really comes down to, do you want to be hands-on or hands-off, trying to look more in especially if it's individual stocks. So great question there. So let's get back here. So now we're going to talk and move our attention over to China. So China's got this, we're looking for this black swan type event. They have a ton of issues going on over there right now, all around growth. So a lot of companies, we saw it with Qualcomm. Starbucks actually performed decently well over in the China region. But overall, China growth has been really non-existent for many industries. And we're starting to see unemployment with the younger crowds over in China. And what the government did is said, oh, we're going to stop reporting on it. It got so bad that they said, we're going to stop reporting what the under, I think it was 25-ish range folks that are unemployed. When things get bad, we have to, let's just pull it. We're turning our attention to other things. Boom, red flag right there. Then the region came out and cut their 1-year medium term rates from 2.65 down to 2.5, a much larger than expected. It wasn't even expected, but a much larger than regular rate cut there. That was actually the largest rate cut since 2020. We remember what happened in during that time. CPI and PPI are showing this deflationary. They're in this deflationary territory, seeing negative growth. They have a massive real estate issue over there with not only valuations continuing to fall, we have these high rates, they have inflation, and then we have one of the largest trust funds in the region have missed their payments over the past month. Bing, bing, another red flag. So there's a lot of red flags going on over in China. The government's trying to transition more into a different type of way they want to lead the country. I mean, you look at this last bullet point here. When we think about Alibaba, that's the Amazon of the China region. Home prices near Alibaba's headquarters have dropped by nearly 20 or roughly 25% in the past 2 years. That is a massive drop and kind of tells you about the struggles, especially within the real estate market over in China. So definitely some things to be concerned about, some things to look out for when you are investing in stocks. You want to look, what kind of exposure does a company have to the China region? Well, we saw Qualcomm get smacked the other day after reporting earnings. Well, they rely very, very heavily, over 60% exposure to that China region. So definitely something to be mindful of. So let me see the questions over here. Make sure I don't have any out there. Do you like ET? I don't really follow Energy Transfer that much. Fabio's in the house. No worries about being late, man. Thanks for joining. All right, we got a question here. As a new investor and able to afford $200 a month, should you invest in high-price stocks like LMT or start smaller in something like Starbucks? So this is Torres, this is a common question I get a lot, and this is how I kind of explain it to folks. Is number one, it's not about the money that you invest. Too many folks these days want to start investing. They say, "Oh, I only have $200. I only have $1,000. I don't care if you have $5. It's about starting the habit, starting to invest. If it's $5 a week, if it's $10 a week, if it's $200 a month, start that habit. Hopefully, you start to be able to increase your income." Both at your 9-to-5 job or whatever it may be, if you're self-employed, but finding other avenues of income as well, trying to get passive income, trying to build that up, which will then contribute more each month. So you're building the healthy habits, making it a priority to invest. But now when it comes to the stocks that you're going to invest in, first it's about building a strong foundation. We talk a lot about this in my 6-week investing accelerator course. We kind of talk about start by building a strong foundation, and then we build a strategy, a customized strategy that fits you, and then an action plan that's going to take place after we build that strategy. But when it comes to particular stocks, if you have $200 to invest, I don't care if you invest in a $200 stock or a $5 stock. You want to look at all the same factors, qualitative and quantitative factors. Is it a high quality company? Do you understand their business? What is their valuations? How well is their management team? Are they efficient in terms of their balance sheet? It doesn't matter about the number of shares that you own. The only time that matters is when you are in the options game. You want to the options trade in lots of 100. So if the stock goes up, both of these stocks, you have the $5 stock and the $200 stock, if they both go up 10%, your money that you invested, your $200, is what goes up in value by 10%. So you would make $20 on both of those, even though you had a $5 stock, a lot more shares, or one share of a $200 stock. So something to keep in mind there. Don't get caught up, especially this day and age when I guess it comes down to, can you buy fractional shares? So that it would matter then if, say, you were looking at a $500 stock and you can only invest 200, then it probably wouldn't work. But this day and age, there's a lot of great brokerages out there that offer fractional shares. Dividend King, LEG has over a 6% yield on cost and currently under $30 a share. Will they recover in your opinion? So a lot of Dividend Kings have not been on many people's buy list all too often. So Leggett had I looked at their Q2 earnings, and I didn't think they were all that bad. But it's just some of these companies are just not, we're in this transition period, especially here in the economy, where they're not really catching up. And I'm trying to look at what's the growth moving forward. I'm still in my mid 30s. I'm trying to look for companies that can still offer substantial amount of growth, but I'm not looking at companies that are offering these 1%, 2% and just chugging along. So you're getting a solid dividend yield here. There's no question. I don't think the dividend is in trouble, but it's more of this play is, okay, these high yield stocks, especially LEG, T, Verizon, VZ, all these companies have these high yields, but the yields are just predicated on a falling stock price. Remember, it's an inverse relationship between stock price and dividend yield. If a stock price falls, a dividend yield will go up and vice versa. So this is a company that's kind of stuck in the mud, I want to say. I'm trying to look at what's the next growth category for them to move forward. I just don't see it right now. I don't own the stock and not looking to own the stock anytime soon. All right, let me catch up here and let's get back. Is that book behind you a good read for REIT? So my buddy Brad Thomas wrote that book. He actually signed it for me. Brad and I have worked together as partners for a while. We still do some work together, and he wrote that book, and it is a tremendous book, especially for folks that are new to investing. But he actually just wrote a brand new one that's coming out. He's going to be sending me a copy. It's REITs for Dummies. You see all those yellow books in bookstores. Barnes & Noble, if you have those around you, I know those are kind of shrinking actual bookstores. Everyone buys things on Amazon, but it is on Amazon as well. But he did a REITs for Dummies version of just to cover the real estate investment trust. So that's definitely a good one as well to pick up, and maybe we'll see that on the back shelf there. So Brad, if you're watching, I'm still waiting for my book there. All right, so let's keep going here with the slide deck, folks. Thank you for keep the questions coming. This is the best part of this Dividend Power Hour, is just to get your guys' questions, interact, and it allows me to, see what's the crowd feeling. What stocks are you guys looking at that maybe haven't been on my watch list? Like, Paul brought up Dollar General. I haven't looked at that one in a while, so now it's time for me to do a refresher on Dollar General and take a closer look at it. So let's move on here. Bet you did not think you were coming to the Dividend Power Hour today, and we're going to see Barbie. So we got Barbie in the house here. So a return of the box office. So we just got word that Barbie surpassed The Dark Knight, which is my favorite movie of all time, as the highest grossing domestic release in Warner Brothers' 100-year history. So let me know if you've watched Barbie in the movie theaters. I have not watched Barbie. I'll probably watch The Dark Knight again before I watch Barbie. But Barbie topped 537 million, which 536 was the previous record there by the Dark Knight domestically. They've collected more than 1.2 billion globally since its release on July 21st. And then Christopher Nolan, on top of that, his Oppenheimer has grossed more than 250 million domestically. So we actually have some movies, apparently some decent movies, out in the theaters right now. So could that be a return of AMC and all of these other theater type companies, which bodes well for real estate investment trusts? And that one of them is Realty Income, has some decent theater exposure there. So again, we're not worried when you're investing in these REITs that we talk about. We're not worried as much about how is the theater doing, the tenant. We want the tenant to do good. As a real estate, as a landlord, you want your tenants to do well. But what you want them to at least get by at the very minimum, because you're just worried about a rent check. If they make a ton of money, great. If they make enough to pay their rent, perfect. That's what we're focused on there. So a return of the box office, that was definitely something interesting and a kind of a fun little thing to throw in there. So let me know in the comments if you've watched Barbie, either of those two movies, I should say. So now the Fed minutes. We usually save the Fed minute update towards the end, but we got Fed minutes that released this week. So yesterday on August 16th, if you're watching this in the future, it wasn't yesterday, but August 16th, the Fed released their meeting minutes from the July meetings. This shows, what was talked about, what was said in during their 2-day meeting. And what came out of it is there's continuing to be concerns around inflation, which could lead to, more rate hikes. So the Fed initially told us in their previous meeting that, or 2 meetings prior, that we're going to have 2 more rate hikes. Whoop, don't want to miss that one up. 2 more rate hikes. And a lot of folks are saying we got our one, and there's not believing that we're going to get a second rate hike. But what's coming out in the minutes, what they're saying out in the streets or wherever they're talking, it's seeming like more rate hikes are coming. Inflation is still high. We got a July CPI down to 3.2. That's great. But the Fed is focused on core CPI, which takes out things like energy and food, which can be volatile. And we're seeing energy prices move up. Not going to help too many things there either. So core CPI is still holding strong at 4.1%. They have a goal of 2%. We are still a ways away from that. Now, we've come down from the 9%. 9% was brutal. It's still brutal right now, but 9% was brutal. We've made great progress. But these rate hikes that we continue to do, they're starting to play out through the market. Companies are starting to feel it. Not only is it going to bring inflation down, it should bring some job activity down as well. And this is where the Fed is trying to get that soft landing. We want to bring inflation down, but we don't want to mess things up with the economy all that much. We know there will be some pain. We know there will be some disruption. We don't want the major disruption, which leads to 5% unemployment, or what's going on in China, I should say, is what we don't want. That's what the Fed's trying to kind of manage through. So interest rates, we're going to look over it. Let's head over to the CME group here, or my CME. So right now we're looking at, this is kind of showing you the next meeting is on September 20th. This is the target rate. So right now we're at a target rate of 5.25. So 525. 87.5% believe that we're going to stay in that range. 87.5% believe we're not going to get any rate hikes in this next meeting in September. There's still 12.5% that say, nope, we're going up another 25 basis points. And that percentage has actually creeped up. I think last week when we were looking, it was at 8%. So we got 4 more percentage points, 4.5 more percentage points of folks that are saying, no, we're going to get another rate hike. So let's kind of see what's the vision for where we think we're going with rate hikes. So if we look here, let me zoom in. This shows us our meetings. So we have a meeting on September 20th. You have a meeting on November 1st. And then our last meeting of the year is on December 13th. These are Fed meetings where they will decide on, do we hike rates or do we pause? So we're at here's our 88% and our 12%. In November, folks think it's going to be 60% believe we're still going to be at the same spot we are right now. However, roughly 40% thinks we'll have at least that one rate hike. So whether it's in September 20th or whether it's November 1st, we're going to be 25 basis points higher. There's actually 4% that still believe we're going to get 2 more rate hikes. So that's definitely something to be interesting. But you could see where the consensus is moving by our May 2024 meeting. 36, the majority believe that we will start our rate cut cycle. So something interesting there, and it will fall all the way through the end of the year in 2024, where we will fall roughly 100 basis points from where we're at right now. So something definitely to be mindful of, to keep an eye on, because what the Fed has said is what they've stuck to, what they've been saying in the markets, what they've been saying in interviews, they haven't shied away from. They've been doing we have 2 rate hikes, boom, we have 2 more rate hikes. That's what it's been. It's just, we keep trying to play like, oh, I know they said there's 2 more rate hikes, but, there's probably only 1 more. This whole course that we've been through, this entire rate hike cycle, they've stuck to what they've been saying. So I don't know why we want to say, let's not believe them now, but this is something to be mindful of. So that gets us to our question of the day. Is we have over 100 people in the live stream right now. That is an awesome thing to see. Thank you guys all for joining. So which sector, first question of the day to the audience, which sector are you most bullish on throughout the remainder of 2023? So we're looking at sector. Let's look at the main sectors of the S&P 500. Is it technology? Is it industrials? Communication services? Consumer discretionary? Consumer staples? What is it? What are you most bullish on for the remainder of 2023? Let me know in the comments section. Now I'm going to catch up on some questions here. You guys are killing it in the chat room right now. Anyone exchanging some J&J for some Kenvue? Not me. LEG is stuck in the mud. Well said. Jim is trading Journeyman, exchanging 33% of J&J. So he's going to kind of diversify. Jim's going to keep a little bit of his J&J and grab some Kenvue as well. James, good question here. Do you use DRIP, or is it better to reinvest your dividends into whatever is a good value? Great question, James. So it's really going to come down to every person's going to be different. So for me, I'm in the markets a lot. I have some that I have DRIPs on, but I'm looking at valuations all the time. So I kind of analyze and go through it maybe once a month, once a quarter, and see which stocks do I have the DRIP on. I'll turn over to my valuation dashboard, and I'll take a look. Okay, that's trading at a decent valuation. Let's just let it ride. Let's keep dripping there. But for the majority of my stocks, I take the dividends and just pool that money together and put it into spots. It might be back into that spot that we just got it from, or it might be into a brand new position or adding to a different position. So for me, the majority of mine, I take my dividends and reinvest them on my own. But that's a good question. It really comes down to how hands-on or hands-off do you want to be. Brian said, J&J, good old reliable king. Thoughts on J&J versus Abbott Labs? Abbott Labs over a 10% CAGR. So I've been looking a little bit at Abbott Labs. And again, for those of you that don't know, this is where AbbVie was spun off from. And AbbVie now has a larger market cap than Abbott Labs. That was their pharmaceutical branch. They spun it off into its own public company. And now AbbVie is one of my favorites. J&J is a big position for mine. For me, I did trim it before we saw a little bit of that pullback. Just because it was just getting too large in my portfolio that I'm comfortable with single stock risk. So, but I continue to have all the confidence in J&J. It's just that, as you put it right here, an old reliable king. So I prefer J&J over Abbott Labs myself if I only had to pick one of those right there. Journeyman is bullish on Kenvue. I've been buying since the IPO, and it's been a little bit of a roller coaster. I haven't seen where it's at lately. Let's take a look and see where old Kenvue. I know it shot up right after after we went IPO, and then we're almost back at the IPO price. So that one's definitely interesting. Hopefully you've been buying more in the $22 range than you were buying up in the $26 range there. So again, Kenvue, for those of you unaware, Johnson & Johnson spun off its consumer health segment. This is going to be things like Tylenol, Band-Aid, Listerine, Aveeno, their baby brands, all that stuff is now part of Kenvue. And the Johnson & Johnson now, that we'll call it the new Johnson & Johnson, is their pharmaceutical and medtech, which is their medical device segments. That is the new Johnson & Johnson. Moving forward, Johnson & Johnson still owns 90% of Kenvue, but they're going through an exchange, folks. They're offering it, which is what Jim's doing. You can take your shares of Johnson & Johnson and exchange them for Kenvue shares. So that's an offer that's out to Johnson & Johnson shareholders right now. What else do we have out there? What do you think of WP Carry? So, Sebastian, I touched on this one early on. WP Carry is one that I'm continuing to add to at these suppressed levels, but it's one you got to be patient with. If we do see, if the Federal Reserve comes out in September and says, boom, we're hiking rates, and we have a few more, like add on to it, then that's going to be concern for REITs, and REITs are going to stay down at suppressed levels. So just know that when you're getting into REITs, that these higher interest rates play a major role on them. So don't expect it to shoot higher all of a sudden without some big acquisition or something that goes on. Paul had a recent trip to Portugal. I noticed that almost all of the tourists were wearing Skechers. Any view on Skechers? I can't say I've ever looked into. I think my daughter owns a pair of Skechers, but I can't say I've ever looked into the actual stock myself. Peter Lynch always advised to buy companies which make popular products, and Buffett even talks about it. Invest in companies that you know. If you don't know anything about that company and it's confusing, it's probably not one you should be investing in. So let's see. Ryan's bullish on energy. Snazzy's bullish on healthcare. So we're defensive so far. Paul's most bullish on healthcare, a defensive sector again. Utilities, another defensive sector. Ola, what are your thoughts on Kava and Kenvue? So we just touched on Kenvue. Kava, I love the food, actually. I wanted to go there. I'm taking my kids out to dinner tonight after this power hour, and I picked Kava. They said no. So it's not, I guess, appealing to my young kids so far. They would rather do In-N-Out or Chipotle. And I can't wait to see the comments now. Are you an In-N-Out fan, a Five Guys fan, or what are the other burger joints out there? Let me know. But I'm always been stuck to my guns and stick with my In-N-Out loyalty, I should say. Fabio, I have REITs in my Roth IRA account, but I'm maxed out this year. Are the tax implications much higher in a regular account? So yeah, you're gonna get taxed. It is taxed higher, but there is something in the top blah blah blah. The Jobs Act that came out during the Trump administration era that allows for a 20% deduction from these REIT. And that's something that a lot of folks aren't aware of when it comes to specific dividends from real estate investment trusts. That's one reason that I have REITs that are specifically in my taxable account. But again, like you said, the majority of my dividend paying stocks, the majority of my REITs are in my Roth IRA, so I don't have to worry about the tax implications. But we're always looking for total return, whether we can get it in a taxable account. Obviously, it's more beneficial in a tax deferred retirement type of account. So definitely be mindful of that. But definitely look up that TGCA 20% tax deduction when it comes to REITs there. Mr. Snazzy, Target or Walmart? Excuse me. Paul tendered 50% J&J into Kenview. Jordan's buying up some real estate for the rest this year and the rest of their life. That's my most bullish. So real estate. So it's really all of these ones that we've said so far are defensive sectors. That's interesting. I haven't seen anyone that has technology yet. There's my In-N-Out fans. We got some Shake Shack. Five Guys. Never been a fan of Five. Whataburger, Texas thing. There we go. I have heard of Whataburger. Chipotle's having food problems. Uh-oh. I like Chipotle. I never get fast food. Yeah, I don't either. I don't think I've been to a McDonald's in over a decade. That tells you how I don't eat fast food. And yes, Matthew, thank you for that. The REIT tax, that 20% tax deduction I was talking about, does have an expiration date. It's not a forever thing. So you'll have to see, it's really going to be, I think, dependent on how the presidential election goes in 2024 on whether or not this tax deduction will stay and continue to be a thing, or if it'll be wiped away. So that'll be something. Thanks, Matthew, for putting that in there. So, all right. Awesome questions. You guys are killing it in the chat today. So back to our question we went through. What is your most bullish? I think it's really the defensive sectors that you guys talked about. Healthcare is one for me, but we're starting to see that broadening out, whether it's broadening out because the tech's coming back to the rest of the group, or the rest of the group's catching up. So that's something we have to kind of take into account there as well. So that leads me to, we were just talking about technology. Is the run for the Magnificent Seven, which is a name I hate, and they talk about it all the time on CNBC when I have it on in the background and whatnot, but we'll go with it. Is the run for the Magnificent Seven over? So let's first look at year to date. So here is the year to date performance for the Magnificent Seven. So you could see NVIDIA up almost 200%. Insane, I know, year to date. Meta Platforms up 137%. Tesla up nearly 80%. Amazon's up 60%. Alphabet, also known as Google, up 47%. Apple's up a mere 34%. And Microsoft is just underperforming and bringing up the rear at 32%. Wow, that is some solid performance there. Now, though, let's take a look. What have you done for me lately? And here's the 1 month performance for those same exact Magnificent Seven. NVIDIA down 5%, actually one of the better performing there. Meta Platforms down 8%. Tesla down 22%. Amazon's pretty much flat. Alphabet is the only stock that is in the green, up 4%. Again, of the Magnificent Seven, Google is one of my favorites. It's really always underappreciated. And this all big overblown thing when Microsoft took OpenAI and we're going to put it into Bing. Really, are people actually using Bing? Do you guys use Bing? I couldn't tell you if I've ever used Bing in my entire life. Google is a verb. Bing is not a verb. Most people don't even know, what Bing is, let alone is it a verb or not. That's my spiel on Microsoft's Bing. I love Microsoft. Don't care for Bing. Apple down 9% and Microsoft is down 8%. So how this compares to the S&P 500 over that same time period, the S&P 500 is down roughly 3%. So Tim, I can tell, is not a McDonald's fan either. McDonald's would go bankrupt if it depended on me. Might have spent $20 in the past 15 years. I might be right there with you, Tim. Awesome. So let's keep moving on here. Thank you, Birds and Bees and Trees. Just subscribe. Thank you so much for that. Appreciate it. All right. Bing gets used by accident. Isn't that the truth? I don't even know if I could come across it on an accident. So now let's move on to earnings season. We did the same thing last week. We looked at some major dividend stocks that were reporting. Here's the companies that were reporting this week. So some big retail names. We see the likes of Home Depot. Not a retail one here, but we saw C Limited, and I don't know if you guys saw that stock or followed. That was the big pandemic. Everyone was a genius with C Limited. That stock fell, I think, over 20% after reporting. I don't know what happened there, but there's Kava. Kava did well. So we saw Home Depot in terms of retail. We saw Target. We saw TJX, which is TJ Maxx. We saw Cisco, an old technology company. And we saw Walmart today. We got John Deere is on deck tomorrow for Friday, August 18th. So we'll have to see what they have in store. That's a stock that my son owns. He just turned 5. So trying to get him involved. I invest. He loves tractors. All right, let's buy some tractor stock, son. You own John Deere. He loves rockets. So he's got Lockheed Martin. His portfolio is crushing my daughter's, who loves Disney. So I got her, I call it the Disneyland stock. And as if you guys follow Disney, you know Disney has been getting crushed. She also owns Amazon, though. That's helped her out here of late. So let's take a look at some of these retailers to kind of see how they're doing and how was their earnings reports that we saw this week. So here we could see these are the companies that I just kind of listed off. So we saw the Home Depot, and I'm going to look at my notes here. We're going to bring up some slides. So bear with me here. So Home Depot reported EPS of $4.65, which was a beat on the bottom line. Revenues came in at $42.9 billion, also beating analyst expectations. So if we slide over here, you guys can see that they also approved a $15 billion buyback. So they reaffirmed guidance, they beat on the top and bottom line, and they approved a $15 billion buyback. You know, Home Depot has actually been doing quite well of late. It's a stock that I've liked a lot. I've talked about both them and Lowe's on a bunch of videos, but revenues were down 2% year over year. So they're still struggling with that. But the comp sales are starting to get less and less. We're starting to get closer to positive comp. So comp sales were down 2% year over year. I mentioned we announced a $15 billion buyback. And the big, I'm not going to call it the bright spot, but the area of concern, we should call it, has been around the big ticket items. So when it comes to the likes of Lowe's, when it comes to the likes of Home Depot, you know, appliances is usually one of their top selling categories. And those are the things that haven't been, investors haven't been, or consumers haven't been buying up on. And that kind of hurts the company overall. So they're hoping that the consumer can kind of get back to that. Get back to here. So next one on our list is Target. So Target reported EPS of $1.80, which beat, but their revenues came in well below analyst expectations. They came in at $24.77 billion, which was a miss. The company reported 5% decline on sales. So let's go over, bring up Target here so you guys can see it. 5% decrease on sales. Comp sales were down almost 5.5%. Expectations, analysts were looking for a decrease on comp sales of 1.7. So that was actually a very sizable miss there. And they've been dealing with some turmoil based on some of their marketing decisions that they went with, and some backlash there. So they're working through all of that right now. And it's kind of a flip script when we look at Walmart, who saw their comp sales increase by 6%. The company, in addition, lowered their full year guidance. So we saw them miss on revenues. We saw them revenues decline by 5%. We saw comp sales decrease by 5.5%, well below analyst expectations. They lowered their full year guidance, but the stock was still up. Tell me, sometimes the market doesn't make sense. And it's really been a case of this stock has gotten beaten down. So they're down. They were down something like 15% over the past 12 months. And it's really been a case of, okay, well, maybe we expected this. We expected a pour with everything that was going on during this quarter. And, you know, one of the bright spots, though, was their inventory management. That's a problem that they've had. During the pandemic, we had major inventory shortages. Well, the following year in 2022, they overordered because they didn't want to have those issues if demand stayed high. Well, then they got this tons of inventory they had to get off their books. How do they get them off their books? Markdowns, 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 clearance racks, markdowns. What does that do? That impacts in a negative aspect. That negatively impacts their operating margins, their gross margins. Well, during this quarter, we saw operating margin of 4.8%. Last year, 1.2%. So that was some solid improvements there. And inventories levels were down. That tells me that we're going to see less markdowns at Target. So, and the other thing, though, that was fascinating, you know, even though their stock has been getting beaten down so much over the past few months alone, they didn't buy back any shares. So that was kind of mind-boggling to me, knowing that their share price is that low, trading at a low valuation. Why don't we buy back any shares? I wish I had the answer there for that one. So next on our list is TJX companies. So they owners of TJ Maxx, Home Goods, They reported EPS of 85 cents, which was a beat, and revenues of 12.76 billion, also a beat there. So this is another thing, a case of the consumer trading down. Maybe not shopping at the Nordstroms of the world or the Macy's. They're trying to go find deals at stores like TJ Maxx. And TJ Maxx also benefited from these companies that were over ordering. They had to get rid of their inventory. Ways they can get rid of their inventory, as we talked about, was markdowns or clearance. Another way they can get rid of it is by selling to the likes of TJ Maxx or Ross stores. So they're getting a bunch of a huge inflow of some solid products. They usually get them a year or two, past their prime or when they actually came to the market. They're getting them much sooner now, and it's going to create higher margins. So TJ Maxx has just been crushing it lately. And if we head over to, let's look at TJ Maxx real quick. You can see they were beating big time. Revenues beat, sales up 8%, beat by $300 million. EPS 85 cents, beat by 7 cents there. Comp sales were up. Their forward guidance comp sales are up. Let's look at TJX, and you could see the growth here. So over the past year, the stock's up almost 30%. Year to date, they're up 12%. So it's just hitting all the right buttons right now, and investors are starting to see that trade down. They have great margins because of the issues that are going on at the Targets, the Walmarts, the Nordstroms of the world, and so on and so forth. So definitely something to be mindful of there as well. So next, let's look at Cisco Systems, stock ticker CSCO. So Cisco reported EPS, a beat of $1.14. That's a beat on the bottom line. They reported revenues of $15.2 billion. That was also a beat. So again, a beat on the top and bottom line. Cisco, it's one of those older companies, the older technology companies. It's not the new age, so it's going to be moving a lot slower, but they've had a fantastic year. Revenues were up 16%. Software revenues up 17%. Software subscription, which is this model that a lot of companies, even the Microsofts, have all moved to this reoccurring revenue thing. Cisco's been doing the same thing over the past few years. Software subscription revenue was up 20%. Their annual reoccurring revenue, so that's what you're going to get from subscriptions, totals $24.3 billion right now. That's up 5% year over year. And the problem, though, with Cisco was their 2024 guidance, their forward-looking guidance that they reported or released, was a little bit below analyst expectations. They were expecting a little bit more there. So a little muted on Cisco. They were up 3% today, so not a bad earnings day for them. So then that finally brings us to Walmart. Walmart reported $1.84, which was a beat on EPS. Revenues $161.63 billion, a beat there as well. So if we head over to Walmart, let me pull up that screen for you guys. You could see that non-GAAP EPS $1.84 beat by 13 cents. Revenues, a massive beat, up 6% year over year, but they beat by $2.35 billion. We were talking about millions and stuff in the last one. No, they beat by $2.35 billion. That's a huge beat there. Interesting. Their global advertising business continues to grow at a fast pace, 35% growth. U.S. comp sales up 6.4%. If we looked at Target, remember, down 5.4. Walmart up 6.4. So definitely a reverse script there for those two companies. So let me head over to the comments and see what questions that you guys have that I may have missed. So let's see here. Thoughts on Wynn? Don't really have one there. Jim said Walmart had some good results. Yep. Mostly from non-discretionary food, grocery items. And that's that component that Target doesn't have as much of. So it could be a slightly different, I'm not call it customer bases, I should say. Been waiting on HD for Chris. What do you think, Gilbert? What do you think of Vici? So Vici is my largest REIT that I own. It's one that I love. It's not too often are you going to go down the Las Vegas Strip and see vacancy signs. They are the largest. So they own the likes of MGM Grand, Park MGM, the Venetian, Caesars Palace, the Mirage, and the list goes on. So Vici it continue to grow each and every year. You look at their portfolio growth, the quality of their portfolio. They're not just at Las Vegas. I think it's around 50% of their portfolio is Las Vegas, but they are the largest landlord, I should say, on the Las Vegas Strip. Great place to be. Whether there's a recession, whether the economy's booming, Las Vegas is usually popping there. So I like Vici. It's going to be a very long-term hold for me. So Chris, thoughts on Domino's? So this is the one that I had a video out right before the massive pop in Domino's shares. So that was my pat on the back moment there. Hopefully you guys saw it and took advantage of it. I didn't, because I was waiting. I usually wait, unless I say it on the video that say, hey, I just bought shares of this. I want to kind of refrain myself from the pump it type. You see a lot of that on YouTube, social media, where you have these folks, these influencers that'll buy a particular stock and let's throw a video out, let's throw a long tweet out and let's pump it, get it up high and then sell it. So not something I do, but Domino's is, if we do fall into a recession, that's a company that's going to do some bright things there as well. So good question. Thanks, Mark. Been waiting for this dip, but seems like we might or could go lower. Looking for entry points, as I've been investing in crypto for a year and a half. Now looking to re-enter the stocks. Awesome. Okay, let's see what else. So one last question here. We did, what is your most bullish? Now let me know, what are you most bearish on? As we only have about 5 minutes left. Which sector are you most bearish on throughout the remainder of 2023? Let me know down in the comment section. So we had a lot of defensive sectors that came on. You had energy, you had healthcare, defensive groups, utilities. Those folks, everyone was mostly bullish on those. Now let's hear the flip side. What are you most bearish on from this day forward in the stock market in terms of sector for the remainder of 2023? Walmart beat their stock, went down 2.4%. Go figure. Yep, they've been kind of firing, been doing decently well. So it was one of those moments where it needs to be a perfect report in order to for the stock to move all that much. Elf is on fire. Which do you? Oh, Jordan. That's like asking me which is my favorite kid. Let's see. In terms of valuation, I'll probably have to go with Realty Income. But in terms of growth, it's definitely Vici. So I own a good portion of both, but I think they're my top two, actually. Vici being one, Realty Income being number two. But that's a tough one. But just in terms of valuation, I'll give Realty Income that slightest of nod. What other questions we got? Kendall, I have 125 shares of Apple, cost basis 162. I'm up overall, but down about 30K from last month. Should I sell now? So obviously, I'm not a financial advisor. I don't know all of everything that goes on in your portfolio. I don't know your entire portfolio, your risk appetite is, and all that stuff. So I can't give specific financial advice. For me, I've had for the past month or so now, I've had a small short position in Apple. The valuation was just way too high for me. Knowing where the economy is right now, knowing that they're priced to perfection and they've started to come down. As you mentioned, you're down 30K in the last month. Well, that's one reason why I'm trying to benefit from the stock falling back. Now, short position isn't something that's very short term for me. But as the company starts to pull back, I'm confident in them long term. I own Apple outright as well. So the short position can be a bit of a hedge to looking at, because I try not to sell these big time companies, the Microsofts of the world, Google's, Apple. The thing is that they're in all of these big ETFs. So as more people pour more money into ETFs or index funds, they're going to have to buy more Apple shares. So I think Apple's going to do fine long term. Will it pull back another 10%? It definitely could. It probably should. So if you're short term thinking, that's something to think about. But a long term investor, I wouldn't worry about the small ebbs and flows. If your time horizon is long, I wouldn't worry about that all that much. But there's ways to, having that many shares in Apple, there's definitely ways that you can hedge your bet with the use of options, I should say. So that could be something to look at as well. Chris says, hold Apple long term. There you go. You look like Elon Musk. Well, my bank account doesn't. Mr. Snazzy, how do you think Nvidia will do after reporting next week? That we just saw they're up 200% in the just year to date. What is that? 7.5 months. So that is fascinating. It's one of those stocks that you got to be you want to be careful of, but they've just been firing on all cylinders. They have a fantastic product. They continue to show growth, but it's one of those things that you want to be mindful of. Are they priced to perfection? Do they have to have the perfect earnings results, showing strong revenue, strong EPS, free cash flow, and showing strong guidance as well. It's like you need a hit on all of those, and that's always a tough thing. So for me, when it comes to these earnings plays, I might throw some more higher risk, shot in the dark type of option plays in just to capitalize. That's what we did or what was it, 2 weeks ago, when I talked about my big hits on Qualcomm falling and Amazon jumping. So something to be mindful of there as well. All right, let's see. What areas are you guys most bearish on? Matthew, transportation. Journeyman, REITs, with good reason. With interest rates, it's a tough sector right now, with interest rates continuing to climb. Oil, remainder of 23 and forever. REITs, real estate will continue to be ugly for 2023, but loading up in prep for 2024. Perfect. Kendall, plus they're going to release the new VR headset on 2024, I believe. In 10 years, Apple will be way up. Is that like Chris, is that the like $2,500 VR headset? Is that how much it is? I don't remember. Thank you, Mark. Very insightful response. I think I shall hold Apple. Awesome. Coke or Pepsi? Are we talking about in taste or stock? I own Coke. I don't own Pepsi. I prefer Coke and not Pepsi in terms of the beverages. REITs stay in the doghouse for 2023. Agree on REITs. Realty Income or Vici, we already answered that one. Pepsi down from 191 to 181. Coke at 60.48. Yeah, I think Coke surpassed the 3% dividend yield the other day. So they're starting to come down. They're always trading at a premium, sub 20, 25 times earnings. So you're never going to get a huge deal on some of these fantastic companies. So we're about to wrap up our show. So if you guys do have any final questions, make sure you put those in the comment section. I'll get to those here in a second. But just want to mention to you, if you're looking to become your own money manager and learn more about investing, definitely check out my 6-week investing accelerator course. So we just opened up applications, or we've had them open now for the past week, to our September cohort. So what we do is this course is 6-week course. You'll be working just with me. You're not going to sign up for a course like many others that are out there and get passed on to some other teacher that'll be going through it. You're working with me. That's why I can only do 7 folks each and every month. We just set up a new website, which I can show you guys. That's one reason we got things up and running again, because you used to have to just email me to inquire about it. But we have a brand new website that I'll put down in the description below. It'll tell you about, talking more about myself, and you can simply click here to book your free. It's a free 15-minute call. We'll go through your investment journey, what you're looking for, talk about my 6-week program, answer any questions you have. And if you're ready to go, then you can just let me know, and we'll send you to our other site where you can sign up and get things ready. So September, right after Labor Day, is when we start the next 6-week course. It's our September cohort, but I only have 3 spots left. So we just had another person, Tim, if you're watching, who'll be joining the September cohort. He was our 4th person to sign up in the past week and a half. So we got 3 spots left. Definitely check that out. You'll see the link down in the description below if you are ready to work with me one-on-one. And if you're just looking for more financial information, you can sign up for our Dividend Investor's Edge. It's our weekly newsletter. We have a free version, which will just give you quick updates on the market. What have they done in the past week? Very similar to some of the information that we cover here on this live show. Obviously, I don't answer questions one-on-one there, but it's just a way for you to keep up. It's sent to your mailbox or your inbox through email every Monday. You can get the top 5 stories of the market. And there's also a premium version where you can sign up for monthly dividend portfolio updates, get full insight into what's going on in my portfolio, my buys and sells. And one thing I'm going to start doing, I get a lot of requests lately, is to start doing trade alerts. So when I make a stock trade, premium subscribers are going to be alerted immediately on what I'm buying, what price I bought it at, how many shares did I add, how did that change, and maybe a little blurb about why I'm investing or why I'm buying or selling a particular stock. In addition, you also get 2 individual stock deep dives. So we still have our 2 for the month of August to come out. So if you sign up for the premium membership in the next couple of days, you will get the next 2, as well as all the previous ones as well, and our investor valuation dashboard. It's less than $1 a day. Definitely take advantage of that. So what other questions do you guys have? Thank you all. This was a record-setting Dividend Power Hour here with well over 100 folks that were in live at just one time. It's just always a joy to be able to talk with you guys, interact, see what questions you have, answer them, help in any way, tell you what I'm seeing in the market, see what you're seeing in the market. That's why I ask these questions. I like to get a feel of what are other investors that watch the stock market. What is their feel? What are their sectors they're looking at? What are they buying? It's just always a joy just to kind of talk. It's low key. I enjoy it. I hope you guys do. With that being said, I don't see any other further questions there. Thank you guys again for joining. I really appreciate it. Smash that like button down below and subscribe to the channel so you're notified anytime we drop a new video, which is always out on Mondays and Wednesdays. And with that being said, have a fantastic rest of your night. Thanks. Bye-bye.